Hey, what's up everyone? Welcome back to the channel and I hope you're all doing well. Want to buy a property but don't have enough money for a down payment? Well, fractional ownership may be your ticket. What are the benefits of fractional ownership? Are there any risks associated with this strategy? And can you really own a fraction of a house? Answers to this and more. Let's jump right in. If you've been following the channel for a while now, you know it's no surprise that many people, especially the younger crowd, haven't priced out of the market. This is especially true for those in the Toronto real estate market and the Vancouver real estate market. However, recently a window of opportunity have opened up for those who are in this situation, for those who have been priced out of the market. Welcome to fractional real estate investing. Fractional real estate investing allows you to own a small slice of equity in a residential or commercial property, such as an apartment building or a commercial business park. There are now platforms available that let you do exactly that. Own a small slice of equity in these apartment and commercial properties. And later in the video, I'll introduce you to two of these platforms, so stay tuned for that. Now, you can't live in these properties, but what you can do is you can benefit when these properties are sold later for a profit. And also receive a little bit of rental income while you wait. Now, on the flip side, you can also lose money if the property is sold later for less than the purchase price. But that can happen, right? Real estate always goes up. Fractional real estate is not a new concept. It's been happening south of the border for a while now. It's just now it's getting a lot more traction in Canada. You may have also heard of another fractional investing concept through Wealthsimple Trade, where they let you buy partial shares if you don't have enough capital to buy whole shares. So for example, let's say you want to buy a single share of RBC, which is trading around $133. You don't have enough money to buy that single share. But what you can do is you can invest $1, $2, or $10 and buy a fractional share of RBC. And if you're new to the channel or you've seen my content before, do me a huge favor. Hit that like or subscribe button, or even that thanks button, because it lets me produce more content like this and you don't miss out on future real estate videos. Now, depending on your experience with investing in general, this concept of fractional real estate investing can be positive or negative. The biggest positive so far is that you can successfully invest over a lifetime in multiple properties without a lot of upfront capital. For real estate investors who can no longer invest in properties because of this massive run-up we've been seeing in Toronto and Vancouver, you now have a new opportunity to build out your real estate portfolio. But at the same time, it's also feeding a new trend called the financialization of housing. Or another way to think about it is that homes are not being treated as commodities and investment vehicles. This is not great news if you're looking to buy homes as a place to live, as now you have new competition to work against you. Because these platforms are buying up homes by the lots, as investors are now able to easily pool their funds together. Along with low interest rates and pandemic-driven lifestyle changes, the concept of financialization of housing will also be a contributing factor on why house prices are rising so much faster. The other way to think about this is that fractional real estate investing has turned the housing market into the stock market, where now you can buy shares of a house just like you would with any other company. Recently, a Toronto condo developer or development group made headlines when they announced they will be spending $1 billion buying up single-family homes just to rent them back out. And fractional ownership of assets, in this case real estate, does not guarantee any income, just like shares or bonds. You have to be mindful, because when you invest in physical assets, through time, they go through wear and tear. For you to make money, the income from these investments must be higher than the cost of maintaining the asset. And that's why it's so essential to know the nature of the asset you're investing in, its lifespan, its maintenance cost, the income generated from the asset, and all the fees and penalties and all the risks associated. And that's why it's so important to do your own due diligence before you invest in any asset, before you invest in anything, to make sure that it makes sense for you and your portfolio. And especially, it makes sense for your risk tolerance. So the first platform we're going to talk about is BuyProperly. This is a fractional investing platform where you need a minimum of $2,500 to invest in a house or condo. And with that investment, you'll be entitled to receive a quarterly flow of rental income, along with any potential profit when the property is sold later on. BuyProperly makes its money by charging a 2.5% fee on your upfront investment. And after those fees, you're essentially left with a return of 1 to 2% per year while you're waiting for the property to be sold. Money invested through BuyProperly is technically locked in for about 5 years, but the company also maintains a secondary market, allowing you to exit before that time frame. BuyProperly has around 300 investors so far who've bought into 11 or so deals in just the past year. Now keep in mind, even though that this is a new platform, you cannot use your TFSA or RRSP to hold real estate directly. Taking a look at the BuyProperly website, as you go onto their homepage, you'll see that it's been featured in multiple news outlets, and they'll give you a quick overview on how the platform works. You can learn about some basic information about BuyProperly, how their platform works. Is it really that simple? According to them, you are less than 7 minutes away from building a portfolio of quality properties. And you can see right here they mentioned that with our fractional real estate model, you can invest as little as $2,500 and see projected annual returns of 10 to 40%. Now, when I see rates and figures like that from new platforms, I always tend to take this with a grain of salt. And so this is where you want to maintain some skepticism when you're seeing figures like this. We help you make smart investments. Now, again, they will market their platform as much as possible to get many investors to buy into their platform. So again, maintain that skepticism. And this is that secondary marketplace I was talking about where you can sell your shares if you don't want to be locked into that 5-year period. Here's what I really want to see. Let's take a look at their marketplace. What properties do they have? You can see there's some coming soon, a property in Hamilton. This is a commercial condominium, $205,000, 4 years, projected ROI at 97%. Interesting. Let's take a look at this one, Ottawa, just launched condo, 840 square feet, 2 bedrooms, 2 bath. Purchase price of $620,000, 5-year term, 33% ROI. So when you take a look at a property, I guess it shows you some nice pictures of the property itself. You can see the purchase price, ROI, the term. This looks like a typical modern condo. Let's see if there's more information. Some details about the location, growth potential, returns. Let's look at the financials. So they're looking for a total funding of $649,000. Here's the purchase price. Here's some closing costs, a reserve fund, and here's their fee of $5,000. So they have a projected annual ROI at 33%, and this is based on that 5-year period. And here is a potential gross rental yield at 5.8%. Now, here's where things get interesting. This 33% assumes a principal down payment and this appreciation over time. Now, obviously, if this appreciation does not happen, this ROI will not be as high. And they have this little calculator where you can sort of play around with your ROI percentages and the amount of holding period. Now, because they're showing a 33% ROI, what happens if the ROI is not as high? What if the property does not appreciate as much? What if you only get 5% appreciation? You invest $2,500 for 5 years. That means you only come out with $3,000. That's not much over 5 years. So you can see that this platform has a lot of guesswork involved, a lot of projections, a lot of guesstimation. And that's why you need to be skeptical when you're looking at some of these numbers, because again, even though that they present a rosy picture, it may not happen. Let's check out some FAQs. I would definitely recommend, if you are interested in BuyProperly, definitely do check out these FAQs to understand exactly how their process works. What are the ins? What are the outs? How does a platform work? How do they make money? How do you make money? What are the risks involved? And make sure you read through this. Here's an interesting one. Should you put all your savings into BuyProperly? No, I agree with that. I would not dump all my savings into this platform. They recommend you treat it as an addition to your portfolio and not put your entire savings into BuyProperly. BuyProperly does not provide tax or investment advice, and any general information is provided to help you make your own informed decisions. So make sure you read through these risks and disclosures for further information. How do they safeguard personal information? How's your investment protected? What kind of properties do they invest in? Residential, commercial, warehouse, and hospitality. This is their process. Who owns the title to the property? Here's their investment process. What are ways to invest in the property? How can you invest in the properties? Again, they mentioned that minimum investment required. You have to be at least 18 years of age. You do not need to be a Canadian citizen in order to invest with BuyProperly. What are the costs of investing? Again, this is very important to understand exactly what you're paying for. BuyProperly charges an annual management fee of 2.5% plus GST or HST on the assets under management. How do you pay into the funds? Interact, wire transfer, or check? Can you use your TFSA or RSP to invest in real estate? You cannot. And there's a whole lot more that you can read through and understand how BuyProperly works to see if it really makes sense for you. The second platform I want to talk about is Addy. With Addy, investors pay a $25 annual membership fee, and you can invest in their properties with as little as $1. And you can invest in commercial properties, apartments, or business parks. But they do have a limit of $1,500 per property. And so far, Addy has accumulated about 7,000 investors who have invested in about 15 or so properties. This company is based out of Vancouver, and they issue shares in the properties they are invested in to the crowdsourced investors. And their goal is to let anyone benefit from Canada's booming housing market. They own residential buildings in the GTA, mixed-use properties in the GVA. They even have investments in a massive industrial park in Calgary, Alberta. And for that $25 membership fee, you get to buy shares in these buildings and profit from that rental income. For a membership fee of $25, you buy shares in these buildings and collect profit from the rental income that comes from the tenants who live in these properties. Let's take a quick look at their website. So this is the Addy website. Right off the bat, they show you your investment opportunities and all these properties, and they've all been sold out. They talk about how real estate is broken, and that's why they've launched this platform. These are the perks of becoming a member of Addy. What makes them different, how it works. Featured on CBC, Globe and Mail, BNN, Yahoo. Let's take a look at some of their properties. They have this River Park Suites in Calgary coming soon. And what's interesting is they actually show you how many investors have invested in a particular property. Let's see if they have anyone that's available to invest in. They've all sold out so far. Everything's sold out. Let's take a look at this River Park Suites. You're going to invest in the development of a multi-residential project with 52 residential units and 3 commercial units that will be part of the next generation of rental apartment buildings in Calgary, Alberta. Estimated term is 3 years. Estimated return on investment is 11%. Estimated owner's day, which is the day when we issue distribution or the property exits. It has a list price of $500,000. It looks like they have some YouTube videos about these various properties. Some highlights: location, investment type, it's high risk profile. Who is it suited for? For investors willing to take on the most complicated projects that may not see a return on their investment for 3 or more years. So they tell you right there that if you are investing in these properties or in these projects, make sure you understand the risk and what the potential return will be. So this seems like a very high risk, high reward type investment. How do you make money? You make money through the sale of the property or through rental income. Let's say if you want to become a member, what does that look like? So if you want to be a charter member, which is $25 a year, access to all properties, no hidden fees, up to $500 in instant funding, unlimited transactions, cancel investment within 60 days, 100% money back guarantee. Interesting. A believer member, which is $500 for 5 years. Same benefits as this, plus $1,500 of instant funding. Invite-only opportunities. This is more like an exclusive club. Few secret perks. Interesting. You have to check out the properties before committing. What are the perks of becoming a member? Again, all this marketing fluff right here. Some frequently asked questions. How will you be charged? Again, I would recommend going through and clicking through all the ins and outs and understanding the FAQs, how the platform works. So that way, if you're not happy, if you have any questions or reservations, that you understand everything fully before making these investments. So how does Addy work? To identify a real estate investment opportunity, investment decisions are made collectively by the real estate acquisition team, our investment committee, and the board of directors. Then Addy divides the investment into equal parts. So the real estate investment opportunity is broken out into increments valued at $1. For example, a $500,000 opportunity would be divided into 500,000 units or shares. Addy then sells these units for $1. So units in the investment are listed for sale on the platform. You can decide how much you want to invest, ranging from $1 to $1,500 per property. I have another YouTube video on how this works, and you can become a real estate investor in 2 minutes. More without marketing. Become a member, fund your wallet, choose a property, sign and invest. Soaring real estate prices have locked down many Canadians out of the housing market and the wealth gains that come with buying a property. Through passive fractional ownership, investors can cash on these returns while having to qualify for a large mortgage or come up with a huge down payment that's needed for a property. Although, through these platforms, it does not give you a roof over your head. It's just a means for you to invest as a real estate investor. It doesn't allow you to actually own a property for you to live in. And investors can skip the headaches that come with managing a property. And you still get a share of the rent and gains that come with owning a property as a real estate investor. Canadian real estate has had a huge run-up spanning many years, but there have been corrections along the way, and prices don't always go up. So investing, whether it's through direct property ownership or through these platforms, it's very important to understand the risk, especially when it comes to new platforms marketing out their strategy to attract new investors. What's interesting to me is that these fractional real estate companies aren't buying enough properties as of yet to really drive up demand in the overall market. But this will be something to pay close attention to as these companies, or if these companies continue to gain traction. Are they really swinging demand one way or the other? But we may be headed in that direction anyways if the concept of financialization of housing really takes off. There will be even more buyers facing a more and more limited inventory. You'll have corporations, you'll have these fractional ownership companies, you'll have buyers who have existing equity, you'll have new buyers competing for the same small pool of properties available. One way to look at this is that real estate is a financial asset, and now more people have access to this asset without that upfront large investment that's required. These platforms may make sense for those who already own a home and want to invest in a second rental property but don't want to have that big financial commitment. Real estate is a top asset class, and most people can't afford to invest in it. Prior to the arrival of these platforms, you either had to find your own group of investors to pool money, or you could buy shares of real estate investment trusts that allow you to own the companies that own properties. All this is doing is now it's adding a new layer into the real estate investing mix. And real estate investment trusts have been around for a while, and you can invest in them through the Toronto Stock Exchange. But now these new fractional real estate companies, it's almost like they're private REITs. And the concept of fractional ownership is growing in popularity, especially in the younger crowd or the older crowd that are interested in DIY investing. And there are many DIY investors out there who are looking to just benefit and take gains from Canada's booming real estate market. And there are some benefits to these platforms. If the housing market continues to go up, that means the shares or your tiny sliver of the house you own for this property also goes up. And that means that you're not falling as far behind because you're invested in the real estate market, albeit through tiny slivers of shares. Now, if you owned a property outright and a major expense came up that was, for example, $100,000 for a major repair, you would have to foot the bill yourself. Now that very same risk is spread across multiple investors. Personally speaking, I would not go throw all my money into these platforms. These are still new platforms that have not been around long enough for them to be really tested. The better approach would be make sure you do your own due diligence and see if these platforms make sense for your personal risk profile. For example, let's say if you were to invest $2,500 into one of these platforms, would you be okay if that money never came back to you? And if you're really interested in investing in these platforms, maybe you limit your exposure to 1 to 5% of your overall portfolio. That way you still get some diversification into physical real estate, but you also have some downside risk protection. These platforms are very new, they come with very real risk, and there's still many unanswered questions. What happens if there are major repairs or expenses? Do they get passed on to the same pool of investors? Does that mean you need to put in more money to maintain your share? Investing is all about finding that balance between risk and reward that you're most comfortable with. Thank you for watching. Make sure you check out the links in the description, and I'll talk to you in the comments section.